Good evening and welcome to the Kansas City Public Library. I'm Henry Fortunato, Director of Public Affairs. Guaranteed to fail, this is actually not about my career trajectory at the Kansas City Public Library, at least not yet. Well, I am not a numbers guy, so to rectify that, tonight we have a really serious numbers guy who I suspect will be throwing out, well, a mind-numbing array of them during the course of his presentation. So in my remarks, I'm going to limit myself to just one number. That number is 150 billion. 150 billion. Put a dollar sign in front of that number, and you will have roughly the current amount of money that we, our children, and probably our grandchildren owe for the bailout of Fannie Mae and Freddie Mac. The colossal failure of these two government-sponsored enterprises, known as GSEs in DC, which is the world capital of acronyms, has been one of the least understood aspects of the financial meltdown in 2008. And yet their stories and their roles are at the heart of this debacle. The people who ran Fannie Mae and Freddie Mac were quintessential Washington game players, which is to say they figured out the sweet spot in the nation's capital. That's a place where you manage to please, or perhaps fool, most of the people most of the time. As Dr. Viral V. Acharya and his fellow authors put it in Guaranteed to Fail, on the left, Fannie and Freddie were vehicles for promoting affordable housing for all. On the right, they furthered the idea of the ownership society. And they were a politician's dream. They reduced monthly mortgage costs without requiring any federal budget outlays. Very sweet. But now the party's over. To tell you more how we got into this mess, as well as offer some suggestions on how we can get out of it and avoid this sort of thing in the future, tonight we've brought you Dr. Viral V. Acharya, the CV Starr Professor of Economics at the Leonard Stern School of Business at New York University. He's been a member of the NYU faculty since September 2008. He's also held high-ranking posts with the London Business School, the Center for Economic Policy Research, and the Bank of England. He's written extensively on the regulation of banks and financial institutions, corporate finance, credit risk, and liquidity risk. And he's won numerous scholarly awards for his research. Dr. Acharya is originally from India, and as you might imagine, he earned his undergraduate degree from the renowned MIT of India, the Indian Institute of Technology in Mumbai, a bachelor's in computer science and engineering. He then went on to achieve his PhD in finance from NYU. Okay, so Guaranteed to Fail, Fannie Mae, Freddie Mac, and the Debacle of Mortgage Finance is available for sale, courtesy of our friends at Barnes & Noble, and Dr. Acharya will be signing copies following his presentation. Ladies and gentlemen, please welcome Dr. Viral V. Acharya.
Thank you, Henry. He took my sort of wonderline for the evening away. Little did we know when we wrote this book that it would actually become a fitting title for the book itself. Let me jump in. I'll relate everything I'm going to say today a little bit to my own background, which is from India. And in some ways, it might seem odd as to what India might have to do with housing finance in the United States. But in some paradoxical ways, it does, and which is this. These are two of the largest democracies in the world. They function in a very similar way, which is that governments can't just do whatever they want. There needs to be some consensus that has to be built. And if governments get it wrong, they could be sort of voted out. But what happens, unfortunately, in democracies is that many times we take it as given and granted that everything that the governments might be doing is necessarily for the long run welfare of the society and the countries. But unfortunately, just like us individuals, like corporate CEOs, sometimes governments get caught up in the short-run game of pleasing their voters. They want to get re-elected. I think if I think about in the last 4 years what I have seen the various politicians talk about, they are sending messages to get re-elected at the next election. And what happens in these re-election propagandas is that you want to offer the currency to your voting bank that they like to be paid in. So that is where India comes in. When I was a small child, the only entertainment in India was to either watch a cricket game or to watch a Bollywood film. And the Bollywood film would be very standard. Of course, there's a little bit of running around the gardens and the trees and all that because it's like a musical. So every 15 minutes, you break out into a song. But before you break out into a song, roughly at about halfway stage, there would be this series of bad guys who sort of crop up in the film. And before their sort of bad and evil intentions get revealed, you see there's usually an election that's taking place in the background. And they're offering Indian women saris. Indian women wear these sort of sari dresses. And the election propaganda is in the form of going around the villages offering saris to Indian women. And when I was a small child, I thought, wow, that's like a cool thing to do. That's how you get voted again. But then when I grew up and started doing some economics, I started wondering who was paying for those saris. And I think in a way, that is where I think my Indian experience relates in some ways, I think, to the housing finance in the United States, which is that I think it has reached the stage it has partly because it has been a convenient way to please the voters in a variety of different ways. This is not necessarily to fault the various decision makers who have gone down this path. And I sort of want to be clear about this one point, which is that when I look at the world through the lens of an economist, I'm not looking for villains necessarily. I'm not looking for people who individually took bad decisions and made things wrong. My own sense is that no matter who else was in the place of many of these protagonists or villains, whatever you might want to call them, they might have actually ended up making the same decisions that these individuals did. And therefore, one has to look a little bit deeper beyond the individuals as to what part of the mechanisms, what part of the institutions that we have out there might have actually made it irresistible for these folks to actually bring the housing finance to the current state of affairs. And I think it's really those flaws that we want to fix rather than find a few scapegoats in the history of the housing finance and once again make the same mistake that they did, which is to send a populist message to the media so that they can beat up on one or two guys as to who we should blame for housing finance. And so I think my sense here, even if at times I sound like accusing some people, I think that's not the idea. I think my sense is if I was put in one of their places, it's quite possible facing the incentives, I might have done exactly the same thing. And which really begs the question that we ought to fix the institutions rather than expect that we just appoint better individuals. I think this country has probably among the best individuals who get into the presidential roles. And so one really ought to think about what institutional details that really went wrong. So this is of course joint work with three of my colleagues, and I should mention that a lot of good that you hear is thanks to them, Matt Richardson, Stein Neuberberg, and Larry White. So I think there is no better summary of housing finance than I think this quote by David Frum, who you can understand after seeing the quote why he was a speechwriter for one of the former presidents. He says that the shapers of the American mortgage finance system hope to achieve the security of government ownership, the integrity of local banking, and the ingenuity of Wall Street. Instead, they got the ingenuity of government, the security of local banking, and the integrity of Wall Street. Now, it's quite a remarkable summary of housing finance. And I'm going to mainly focus on the first aspect, which is that the overall objective in shaping housing finance the way it has been shaped in the United States was to offer it the security of government ownership. What I mean by this is that when the United States was recovering from the throes of the Great Depression in 30s, housing finance was once again the quintessential problem, the way it is right now, at least on a secular basis in the United States. What was identified as a solution? The solution was to create this new deal in which the government backstopped and supported important parts of housing finance in the United States. And over time, this model evolved in the following way, which is that small mortgage lenders in different parts of the country would figure out what mortgages they wanted to make. These are the mortgage lenders who would know the individuals in their towns. They would understand what they are doing to make a living. They would understand their employment upside and downside. And so it's really these lenders who ought to determine what mortgage someone should get, if they should get a mortgage in the first place, how much, what loan to value ratio, what interest rate, and so on. But if we really organized housing finance in the form of very small mortgage lenders all over the country, then whenever there are regional shocks, these mortgage lenders might collapse because they are really exposed to the employment and the housing in a small state or in a small neighborhood around where their branches are. And so the idea was to take these mortgages once they were originated, as Henry was saying, effectively to Washington, D.C. What do I mean by that? Is that take Fannie Mae, which was one of the principal child of the government backstopping of housing finance in the Depression. Fannie Mae was formed in 1938. The idea was that you would take the mortgages from the small mortgage lenders to the balance sheet of Fannie Mae, and then Fannie Mae would essentially guarantee the credit risk of these mortgages. So if there was a wave of defaults in Florida, it's ultimately Fannie Mae that would bear the default on these mortgages. But if there were just some prepayments and other kinds of risks on mortgages, those would get redistributed by Wall Street to the rest of the capital markets. So the beauty of this was that it could very well be that ultimately most of your mortgage risk was held by a Norwegian village pension fund. And it's really that pension fund which was directing its financing into the United States to support housing finance. Along the way, there's a whole set of actions that has to take place. Once these mortgages are guaranteed by Fannie Mae, Wall Street has to take these mortgages. They are to be distributed to the Norwegian Village Pension Fund. They recognize that ultimately, even if there are defaults in Florida, they are not bearing the risk, and therefore they have to pay a fee to Fannie Mae for buying that insurance. So effectively, if I took the mortgages made in Florida and transferred them to the Norwegian Village Pension Fund, when defaults take place, the Norwegian Village Pension Fund would make losses. But in what was the design of the mortgage finance, that wouldn't happen. The Norwegian Village Pension Fund would not make losses from defaults in Florida. It's Fannie Mae that would make the losses. In return for this, Fannie Mae would earn an insurance fee from this Norwegian Village Pension Fund. Okay? Now you can see that there's now a very complex web of financial transactions that is taking place. A small mortgage lender first makes the loan, assesses the credit quality, takes the mortgage, sells it to Fannie Mae. Fannie Mae then sells it to Wall Street. Wall Street then might repackage it and sell it to the Norwegian Village Pension Fund and so on. And of course, this is only the first time it happens. The Norwegian Village Pension Fund sometimes may not want to hold some of these mortgage securities and might sell them back in the market to some other people out there. Now, the key point is that at the end of the day, who is bearing the risk of mortgages in Florida? For most part, it was Fannie Mae. Okay? And therefore, the extent of support to the mortgage market that could be provided was a function of what kind of mortgages was Fannie Mae willing to buy from the local mortgage lenders, and whether they were willing to provide the insurance to the rest of the world to hold these mortgages in a very cheap manner or in a manner that was appropriate for the risk of the mortgages in Florida. If Fannie Mae wanted to kickstart a housing bubble, all that they had to do was to deteriorate the standard of mortgages that they were willing to buy and tell the mortgage lenders in Florida, even if you make a 90% loan to value mortgage, I'm happy to buy it. Now, how would they be able to sell it to the Wall Street and the Norwegian Village Pension Fund? They would say, listen, last year I was charging you 50 basis points as the insurance fee. I'm going to sell these mortgages to you for 25 basis points. Please come and buy them. Okay? Now, you can see therefore that this is potentially, in principle, this is a recipe for fueling housing bubbles in the country. Why? Because there is just one thing that has to go wrong in this one massive institution, which is to essentially create an incentive and allow the underwriting of poor quality mortgages and their onward sales through Wall Street and others out there in the world, so that the cost of mortgages becomes cheaper. Families that might not yet be deserving mortgages for buying houses end up with mortgages to do so. And the story continues. So in some sense, what was supposed to be a very passive role of the government, which is that it's really the mortgage lenders, let them decide what they want to do, and we will just guarantee these mortgages. From a passive role, it became a really active role, where rather than the mortgage lender first deciding which mortgages we will make, and then going to Fannie Mae and saying, yes, these are the mortgages I have made, do you want to buy them? Instead, it is Fannie Mae that started telling the mortgage lenders, these are the kinds of mortgages I'm going to buy. Please go and make them. Okay, and that's really the source of the distortion. What is supposed to be a passive government role essentially became an active government role. And as I was saying earlier, it became a way of offering a currency to the American households that they liked, which was essentially to own homes. And as I said, ultimately, the biggest question one has to ask whenever government subsidies are offered is, who is paying for it and how are we paying for it? Is the current generation paying for its own subsidies? Or are these subsidies essentially being piled up and it's going to be the next generation that's going to pay for it? Whenever that happens, which is that collectively one generation, either consciously or unconsciously through what the government subsidies are doing, ends up over-consuming of anything. It could be housing, it could be healthcare, it could be fuel subsidies. Whenever a current generation ends up over-consuming at the expense of the other, it becomes unsustainable beyond a point, and it has to face a correction, as we have in the form of the deep housing crisis we witnessed. So that's the sort of rough story I'm going to try and sketch over the next 30 minutes or so. So let me go through some little bit of more details, and I'm going to try and keep the numbers to a bare minimum. But I think some numbers are important just to get a sense of the problem that we are facing right now. So there are two large government-sponsored enterprises. There's close to 10 of them in the United States. But the two largest that are perhaps central to the housing crisis that we have right now are Fannie Mae and Freddie Mac. When I was writing the book, my son asked me, Daddy, why don't you come to the park with me? And I said, I'm writing a book about Fannie Freddie. So he said, what's that? Can you explain that to me? And I said, it's a little bit like Humpty and Dumpty. And I said, in what sense? He said, yes, so Humpty Dumpty sat on the wall. They sat on Wall Street. Humpty Dumpty had a great fall. And all the king's men and all the king's horses couldn't put Humpty Dumpty together again. And I think that's a good summary of sort of what really happened to Fannie Freddie, which is they sat on Wall Street and they basically grew very large. And they are so large right now that they are about $5 trillion of a balance sheet. Now, the United States residential mortgage market is about $10.5 to $11 trillion. Okay, so Fannie Mae and Freddie Mac are practically 50% of this share of mortgages that are out there. So there's commercial mortgages out there. Fannie and Freddie cannot participate by law in that business. If they were allowed to, they would. But out of the $10.5 trillion of residential mortgages, they currently own 50% of this market. What that means is that effectively 50% of the credit risk, the 50% of the risk of defaults on United States residential mortgages is ultimately borne by the taxpayers of the United States through these government-sponsored enterprises. Now, that in itself would not be too big a problem if all these mortgages were always of the highest quality. So one has to understand, how did a big chunk of this $5 trillion of mortgages over time get to be of somewhat degraded or poorer quality? Now, there are two businesses that they engage in, and they started at different times. The original business of Fannie Mae and Freddie Mac was not to own the mortgages themselves. As I explained, the idea was to pass it off to the Norwegian Village Pension Fund. So that first part of business is called as securitization in the language of finance and economics. But really what that means is that you don't buy the mortgage and keep it yourself. You pass it on to someone else. You make some fee along the way. That part of their business is the larger business. It's about $3.5 trillion. The business that actively started in 1992 was the business in which not only did they buy the mortgages from the lenders in Florida, and now they did not even pass them on to the Norwegian Village Pension Fund. They primarily just owned these mortgages themselves. Okay? This business is about $1.7 trillion. Now, I've already touched upon a brief history of these entities, but I think it's important to understand their evolution, because I think that is where one understands the political motives for having such a huge imprint in the housing market on part of the government. But more importantly, it's going to help us understand why the temptation of using the government balance sheet to continue to backstop the housing market right now may be very dangerous down the road. Okay? So as I said, Fannie Mae was formed in 1938. In 1968, Fannie Mae was privatized. Now, this is probably the first seeds of the kind of problems that were going to materialize down the road. So the privatization was done during the Lyndon Johnson administration. And why was Fannie Mae privatized? Fannie Mae was privatized because until then, Fannie Mae was on the balance sheet of the United States government. What that means is that if Fannie Mae goes out and issues $50 billion of debt, you have to consolidate that $50 billion of debt with the other debt that the United States government has. Okay, so to give you an example, what do I mean by this? Last August, we had a big a sort of near debacle on the debt ceiling of the United States government. So someone is calculating the various debts that the United States government has and checking if the debt ceiling which is imposed on the government is being violated or whether the debt is under the debt ceiling. Now, what the government did in 1968 was to privatize Fannie Mae. What that meant was that because the government was not the owner of Fannie Mae, you didn't have to consolidate or recognize the debt of Fannie Mae anymore on the government balance sheet. Okay? This effectively meant that it became off balance sheet. Okay? So let me just give you an example from India again. I can't resist it generally, which is that in India, if you go to an entrepreneur or a businessman and you ask him, can you show me your accounts? He will say, do you want the book above the table or do you want the book under the table? The more sophisticated economics way of describing it is, do you want stuff that is on my balance sheet or do you also want the stuff that is off my balance sheet? which is the stuff that I'm not accounting for when I do my calculations, when I show it to my investors and so on. So effectively in 1968, Fannie Mae's debt became off balance sheet. Now this would not have been a problem if the markets truly believed that even Fannie Mae's debt was not the debt of the United States government. But that never happened. And there were several reasons for this, because unlike any other company that was listed on the New York Stock Exchange, Fannie Mae had 5 board members that were appointed by the United States government. Okay. Fannie Mae's debt could always be taken to the Federal Reserve to exchange it for United States dollars. What this meant was that capital markets always thought that even though this privatization has been done, really the United States government wants to control housing finance. They want to be in Fannie Mae. They've just done this accounting trick to take the Fannie Mae's debt off the balance sheet of the United States government. But really, if Fannie Mae fails, is the United States government not going to honor its debt? Capital markets always believed the United States government would honor the debt of Fannie Mae. Following these privatization, it was felt that given that Fannie Mae is private now, we need to create some competition for it. So Freddie Mac, the Dumpty of Humpty and Dumpty, was created in order to compete with Fannie Mae. And even though this kind of structure came about, there's a very nice book much earlier than sort of what we wrote on this by Peter Wallison. It's called Serving Two Masters, and it's really about Fannie Mae and Freddie Mac as well. And what he explains nicely in the book is that this privatizations in 1968 and then the formation of Freddie Mac as a private entity, it meant that these entities were always serving two masters. On the one hand, they had shareholders who effectively said, please go and make some money. Please generate some profits. If you want our capital, we want you to earn the highest possible return that you can earn on our capital. Expand your business. That's how you're going to make more money and give us a high return on our capital. So that was one of the masters that they had to serve. But they also had another master, which was the United States government itself. If the United States government, either directly through its regulation of these entities or indirectly through the board members that it had appointed on these entities, wanted them to do something else, they would now veer off into a different direction. And what you got through this sort of cocktail of trying to serve two masters was in some sense quite bad. So in the 80s, there was a wave of privatizations that took place. Fannie Mae and Freddie Mac were both allowed to do a large chunk of slicing and dicing of mortgages from then on. But we think that the real sort of big breakthrough as far as leading towards the financial crisis was concerned happened in 1992. In the book, we call this as crossing the Rubicon. Okay, so why do we call this act, as Henry said, DC loves acronyms, so this is this FHEFSSA Act. So why was this crossing the Rubicon? Until 1992, most of the mortgages that Fannie Mae and Freddie Mac purchased or sliced and diced were of very high quality. They were what were called as conforming mortgages, not too large in size, of fairly good loan to value ratio quality, and good documentation of the borrowers, the homeowners who took out the mortgages. And whatever credit scores were being used at that point, now they use a score called FICO score of the borrower. But whatever credit scores they were using for these borrowers, they would all be very good. What this meant was that even though there was always the temptation of the shareholder, the sirens that were calling the Fannie Mae's management saying, keep generating more profits for us, even though the sirens were always calling them, they just didn't have too much freedom, because they had to make really good quality mortgages until then. But in 1992, it was felt that most of the support that Fannie Mae and Freddie Mac had been providing, because it was limited to conforming mortgages, that this was really not serving the low-income households in the United States. So there were lots of graphs that were produced which would plot the entire demographics of a big city. And they would show that the inner neighborhoods of the cities very often had very few loans or mortgages that were ultimately supported by Fannie Mae and Freddie Mac. The support through the government of mortgage housing was primarily in the middle class or the relatively wealthy who were buying, say, second mortgages with some of the mortgages that would qualify for Fannie Mae and Freddie Mac mortgages. So in 1992, the government crossed the Rubicon and said, we want Fannie Mae and Freddie Mac to actually make low quality mortgages. Okay, which is to say, for every dollar of activity that you do, we want you to do a certain percentage. It started off being around 17% to 20%. And progressively by 2005, it had reached over 50%. It said for every dollar of mortgage that you acquire, we want a certain percentage of this business to be in the low income affordable housing goals. So these were called as mission goals or mandates from the United States government. And now you can see why serving the two masters came together to produce something quite toxic. Because the sirens from the shareholders were saying, go and do more business. But how do you do more mortgage lending if you preserve the quality of the mortgages to be high? You simply have to stop at some point. But now, if you are in fact told to make low quality mortgages, there is an easy way to expand your mortgage book, which is to simply lend down the quality curve and deteriorate the quality of the mortgages that you are going to support along the way. And so we think that while a series of changes ultimately led to the sort of more toxic component of the mortgages that Fannie Mae and Freddie Mac ended up supporting, it was really the 1992 Act which in some sense enshrined for Fannie Mae and Freddie Mac that yes, you could grow to large numbers and you could also deteriorate the quality of your mortgages. Okay, and this is what is like a perfect recipe for housing bubble and the eventual burst. So let me just give you a sense of how rapidly some of these changes took place. There are two lines here, and I'll try to explain them in very simple terms because I think this is a very important graph to understand to get a sense of how the housing market in the United States has changed. In 1980s, Fannie Mae and Freddie Mac together owned less than 7% of the total residential mortgage pool of the United States. This was largely a private housing market. Mortgage lenders that made the mortgages often owned them. Sometimes they might be able to pass them on to others, but this was largely a private market. In the 3 decades from then, the share of Fannie Mae and Freddie Mac through both of their activities grew, and now it's actually slightly above 50% as a whole. So from what looked like essentially a relatively private market with some imprint of the United States government, but not very large, we've moved to a point where this imprint has become essentially very large. And there is something almost sort of schizophrenic about this as far as the US capital markets go, which is that the US private financial sector is fiercely private. Even though ultimately we had to support some of the banks that failed in the financial crisis, Lehman Brothers was let go because the United States Congress could not accept injecting capital into the private sector banks. Okay, it was only after its consequences were realized that it was accepted that maybe we are in a big mess and we need to do something once. But there's a sense in which the private markets are fiercely private. It's not like the banking sector in India. It's not like the banking sector in China, where there are huge state-owned banks which control credit allocation to corporations, not just in housing. But if you switch now focus away from banks into housing finance, It's suddenly a market now where everything is actually about the government. Out of the new mortgages that are getting made in the United States right now, more than 90% of the mortgages are ultimately supported by some of the government-sponsored enterprises, either Fannie Mae, Freddie Mac, or the FHA, which is the other now large government-sponsored enterprise. And so this share has grown dramatically over a period of time, and this has also been the period of time in which the housing prices in the United States have actually registered essentially an unsustainable growth out there. And there is something important about this housing price growth prior to its burst in 2007. So think about the 1992 Act, which told Fannie Mae and Freddie Mac to start supporting low-income and affordable housing. Now there's another way of supporting low-income housing, which is to say, we'll just give you money. We'll collect more taxes. The big share of the taxes comes from the families that are earning more and can pay larger taxes, and we'll just give you cash. Now you decide what you want to do with it. Do you want to own a house? Do you want to send your child to a better school? Do you want to spend on buying a car? It's up to you to decide how you want to do it. Okay? But that would not please one part of your voting bank, which is those who would be paying these taxes. So which is the way to do it? The way is to tax the future generation. And how do you tax the future generation? You take on debts for which you are not collecting any taxes for their payments right now. But there is a debt ceiling that is in place to take care of this problem. But that's why you need the second book. That's why you need these housing finance vehicles who can build up the debt, but they are completely outside of the control of the debt ceiling. So over this period, when the housing prices are rising, the irony is that when you don't give cash to everyone and let them decide what they do, but you tell them no, only if you take a mortgage out from your mortgage lender will I actually give you the subsidy, which is, I will make it cheaper for you to own the mortgage. Now what is the problem? The problem is, of course, this is available to everyone in the economy. So I'm going to buy a house, you are going to buy a house, someone there is going to buy a house. So two things happen. One, house prices start rising because all of us are getting cheap mortgages to buy the same plot of land. So one, it means even though I'm getting the subsidy on the mortgage, I'm actually paying more for the plot of land than I would have otherwise because everyone is getting this subsidy. Okay, so I like it when I think about it, yeah, I'm getting a very cheap mortgage, but not quite, because you're actually paying a lot more for the house price because everyone is actually getting a cheaper mortgage. So on the one hand, you are trying to distribute homes and wealth to the affordable, to the low-income households. But on the other hand, you are quickly taking it back away from them because the house prices are actually rising at a very fast pace in the country. So it's not even clear that this way of transferring subsidy has actually done anything at all for the low-income households in the country. It gave them a flourish of a hope as long as the house prices kept rising, but it was all just quote unquote an unsustainable scheme that collapsed, and now many of them are sitting on underwater mortgages, probably cutting back on their consumption and leisure in order to pay down their mortgages, or they've defaulted on their mortgages, inflicting severe pain on Fannie Mae and Freddie Mac and other mortgage lenders and so on. So over this period, the mortgage quality declined very substantially as well. And you can see it using data that Fannie Mae have themselves actually provided in their balance sheets, that right from 1992 to 2002, the overall quantity of low quality mortgages, so the red bars are for mortgages which have loan to value ratios which are greater than 90, and the blue bars are for those mortgages which have loan to value ratios which are between 80 and 90. And what you see is that there were many years, even prior to 2002, 2003, when they were doing 35 to 40% of their mortgage lending in the form of very risky mortgages. So sometimes the blame gets laid at the table of the private sector banks, and something I'll skip in this talk, they had enough share of blame to take themselves. But it's not true that the bad mortgages were made primarily just from 2003 to 2007, when the private sector actually got very active. There has been a steady deterioration of mortgage underwriting standards in the United States right from 1992, when we crossed the Rubicon by telling Fannie Mae and Freddie Mac, yes, you can make risky mortgages if you want to. So I'll skip some of this. So the big question that arises then is, can mortgage finance exist without the presence of Fannie Mae and Freddie Mac in the housing finance system? Now, one reason why I showed you that graph where the Fannie Mae and Freddie Mac share was quite small before 1968 was to show that we have ourselves been in that system where Fannie Mae and Freddie Mac actually don't have a very large presence in the housing. But one can also look at the rest of the world. You can look at Australia, Canada, Japan, Spain, Netherlands, Germany, UK, and US. And this green bar is what shows is the presence of something that's similar to Fannie Mae and Freddie Mac in the rest of the world. And you can see that it's only in the United States that these agencies, Fannie and Freddie, essentially dominate housing finance. In other parts of the world, housing finance is organized in many different ways. And some of them, not all, but some of them have worked reasonably well. Second, you can look at home ownership rates in different parts of the world. So one might think that with this bigger push into the housing finance, home ownership rates in the United States might actually be quite high. One, they are not. And this is for the reason I just described, which is that if house prices keep rising at a very fast pace because you are subsidizing it, a lot of families are not going to be able to afford housing even with the subsidy. But what is more important is that if you go to the left here, you see countries that have had extremely high home ownership rates. Spain, Iceland, Ireland. And it's not clear you want to swap places with them right now. Which is that maybe even with all its troubles, we are far better being here than being to the extreme left over here. And I think the reason is simple, which is that essentially mortgaging is taking on a very significant leverage on your balance sheet. For anyone even wealthy who has bought a mortgage, it's clearly the single most expenditure out of your paycheck. It's the single most important expenditure out of your paycheck. So when the level of your income is itself small and your employment sustainability not that high, it just doesn't make sense to take out a mortgage. You might have to wait. That wait might be a generation potentially if it takes you one generation to actually expand your wealth until you get to a stable wealth level where you can afford housing. But there's a simpler way to consume housing, which is to just rent. And often that is good because it's not going to force you into a bad bankruptcy, forcing you to cut back on your consumption, really to just keep making the payments that you had out there. So I think one has to change the idea of home ownership in the following sense, which is that one wants to eventually give homes to everyone. I think that should be a good goal, for a society to have. But that doesn't mean that everyone right now has to have a home. I think what one would hope in a dynamic society is that everyone has a chance to move to the top. So regardless of where you are, you could educate yourself, get the right skills, and become the big entrepreneur of tomorrow, and then you could be owning a big multi-million-dollar house. But this pool of who is renting and who is owning should, in a dynamic society, should just keep mixing over time so that people are springing up from everywhere with bright ideas and essentially becoming wealthy in their generation or the next generation and so on. But I think the only way, it seems from what we have seen in the society, to build extremely high home ownership rates, which is often considered as the American dream, is that the only way to get there is to really bankrupt your governments themselves. And I think one has to sort of ideally stop short of getting there. So therefore, how should one think about mortgage finance reform? It seems that most economists, for a change, agree on something, which is to say, we don't want to be at the left point over here. Okay, we don't want to ruin completely the balance sheets of our governments. And for that, you need the government to gracefully exit. In the book, we call it as putting the genie back into the bottle, which is that 75 years back, when we were coming out of the throes of the Great Depression, we took out this genie, which was to use the second book of the government to support the housing market. Now it has become so large that you have to unwind it and find out a way of putting the genie back into the bottle. Now, it's not easy because it's 50% of the size of the housing market. So you can't do it overnight and say we are just shutting down these enterprises, because that would produce a massive collapse and a housing price correction and inflict even further troubles on the homeowners in the United States. So our solution is the following, which is that we have to wind down Fannie and Freddie, but it has to be done as a weaning rather than a complete shut-off from the market altogether, which is every year the goal should be, for example, to reduce the presence of Fannie Mae and Freddie Mac in the market by, say, 5%. So if they are today at 50% of the market, in another 10 years' time, they would have exited this market. And I think if we achieve that, it would actually be quite an accomplishment, because they have grown to their size in a period of 70 years, but particularly so in the last 30 years. And so it is still, even 10 years is actually a rapid exit. You're trying to unwind institutions that sort of ballooned over a 30-year period, and you are trying to sort of shrink them down in a 10-year period. Now we think that the time is actually particularly ripe for doing this. The reason is because after the financial crisis, a lot of time, effort, and money is being devoted to regulating better our private financial sector. The banks, the bank holding companies are all being subject to a slew of financial sector reforms, which over time is going to actually make the financial sector more resilient than what it was before. But if you have that, why not let them now going forward take the risks of the mortgage market rather than having this continuous push of the government in there? So one way of achieving this would be the following, which is to say, for every new mortgage that gets made, if Fannie Mae and Freddie Mac are guaranteeing them, they will only do 75% of that. 25% will actually be guaranteed by a private sector counterpart. So it's a public-private partnership to start with. But what you could do is every year you could bring down the size of the mortgages that Fannie Mae and Freddie Mac are guaranteeing. So let me explain what I mean by this. Before the financial crisis of 2007, the largest mortgage that Fannie Mae and Freddie Mac could purchase was $417,000. There's always this $420,000 mortgage. If you go above that, your rate climbs up. Why was that the case? Because then you went into the private sector buying your mortgage rather than Fannie and Freddie. And so keeping your mortgage under 420 was a way of getting the subsidy that Fannie Mae and Freddie were providing to the housing market. During the crisis, these limits were raised to support the housing market. So in some parts of the United States, these limits are as high as $600,000 and even higher. Okay? So how would you wind down? You would have to say that every year we are going to bring down this limit from 600 all the way down to zero, say through increments of 75,000. So in the area where it's 600,000, you say next year Fannie Mae and Freddie Mac can only guarantee mortgages up to 525. 625, then you'd go to 550 the year after, 475 the year after, and so on. Now, the important thing is that you have to do this in a credible manner. You need a plan. You need to tell the private sector that we have a 10-year plan for winding down Fannie Mae and Freddie Mac in this manner. Why is this important? Because then the Norwegian Village Pension Fund will recognize that Fannie Mae and Freddie Mac are no longer in the business. They have to go to the private sector banks in order to do this. The private sector banks would now start getting ready for becoming a significant player in this business. And over time, they will contribute more and more capital to this activity. So just one last point, and I think I'll stop there. The question that gets asked often is, what's wrong with, so right now, Fannie Mae and Freddie Mac have very tight underwriting standards. They are only underwriting mortgages with very high credit scores of homeowners. All the mortgages are below 80% loan to value ratios and so on. So it's very tempting right now to say what's wrong with this model. The problem is that that is the model right now. There is no guarantee that 20 or 30 years down the road, some government caught up in its populist desire to start making low quality mortgages won't use Fannie Mae and Freddie Mac again to make worse quality mortgages. And I think therefore one has to sort of go through this history and recognize that things were well intentioned to start with, but they went wrong because it was possible to go wrong with the structure that you had. And the primary reason for unwinding Fannie Mae and Freddie Mac right now, rather than down the road, would be that the desire to unwind from them is going to be declining over time as and when economic recovery comes back. And we have to really worry about a mission creep coming through. So let me end there so that there is time for some questions. Two things I didn't mention. All of us as authors would by and large support some support for first home buyers. We think that if you haven't owned a home before ever, it probably makes some sense to give you some subsidy in order to acquire a house. But we would like it to be on the first book of the government. We want the government to collect taxes and set aside money for providing the subsidy. The second point is, what about the broad mortgage tax deductions that we have out there in the system? Again, our preference would be to offer these only to the first home buyers. We don't think that there is a need to subsidize home ownership if you're buying a second home. There's no need to subsidize home ownership if you have been a homeowner and now you have become so wealthy that you are buying a bigger villa, a bigger mansion, a bigger plot, and so on. If we keep subsidizing housing even for the very rich, all that happens is you just keep over-consuming housing because it's very cheap for you. If you stop this, all that will happen is we'll have slightly smaller houses, we'll have slightly smaller construction industry, but maybe that just means there are more jobs that we'll have to eventually create in biotechnology or create some other version of iPad that really sort of takes the world by storm. Let me stop there and take some questions. Yeah, thank you.